Good evening, everyone, and welcome to tonight's webinar. My name is Roger Galway, and I'm going to be presenting tonight. And today we're going to be talking about understanding the property clock. Now, first of all, I just want to make sure that I'm coming across loud and clear. So if you could just please raise your hands on the right-hand side on the dashboard. If you can raise your hands to let me know that you can hear me loud and clear, that'll be awesome. I'm going to share my screen also now. So can you please make sure that you can see my screen? Okay, excellent. I can see some hands raised, so that's good. That's good to know that you can hear me loud and clear. Thanks, everyone. As I said, my name is Roger Galway. I've been a property investor for just on 19 years now. A branch manager with the club for the last 14 years. So this is what I do full time, and I've been a mentor for 17 years. And then I've also taken on the role of a researcher in Melbourne for the last 6 years. So a bit of experience behind me, and this is what I'm hoping to share with you. And again, this topic of being under the property clock is a really good topic, which I think is really good to understand and to see what we're going to talk about. Okay, so let's start and see what we're going to cover tonight. So tonight, one of the things which I'm going to be talking about is basically why people are financially secure. And one thing is scary is that 95% of people are not financially secure. There's over 73% who are dependent on welfare. And this is the statistics from the 2016 people who have retired. Most people are on government pensions, 73%. And there's 7% of people needs to work to continue working to survive. And there's only 4 people who are financially secure, and there's 1 wealthy person. These are the people who retired in the retired and at the 2016 census. Now, I know this year we are expecting another census, so hopefully these figures will change. But these are the figures which have come across. Now, I know I want to be in that 5%. You have to decide where you want to be. And I know I'm working very hard at the moment to try and be in that 5%, but that's where I want to be. I want to be financially secure. And that's important from an investment point of view. And that's why we invest. So what are we looking at? Now, why is the clock so important? Well, the concept of the property clock is crucial because it shows us where the market is and where the market is going and what is currently happening with the market. And when is a good time to buy, when is a good time to sell, and when is a good time to get into the market, and when it is to recover your money or take equity from there. Now, one thing with the property clock, it doesn't work the same in all locations, and I'll show you why that is. Okay, because the different drivers which and the clock, the cities move around the clock. And what you need to understand is in which position you need to act as a property investor. So I'm going to talk a little bit about that. So you'll see that in my next slide now. Now here, these are the 4 types of main quadrants which we talk about. You have boom at 12 o'clock, and then you have the declining market which is coming down at 3 o'clock, and then you have the bust, which is, well, it's an oversupply, or the market is bottoms out at about 6 o'clock, and then you see the recovery going up to 9 o'clock, and then it goes back in a cycle. So some of them, and in fact you'll see that there's an upswing and there's a downswing, and sometimes it doesn't, most of the time the market goes in a clockwise direction, but sometimes it doesn't. And I'm going to talk a little bit about that and how that works and why it works. So basically, property markets go through a cycle. So you have the peak at 12 o'clock and you have the bottom at 6 o'clock. And then you have a downswing which comes up off the peak, and this is going to happen to any property in any market. So this is how there's a downswing and there's always an upswing. Sometimes an upswing follows a downswing, sometimes a downswing follows the upswing. So it just works in cycles. But that's what it is. And you'll see the markets, how quickly, and I'm going to show you how the market is. So let's look at the first current market at the moment. Now this information, the property clock is taken from Heron Todd White, and this is the latest data, the April data. You can go and Google the property clock from Heron Todd White and you'll get this information. So it's freely available for anyone to go and check out. Now this is the current market in houses, and this is what Heron Todd White have come up with. So you look at it, a lot of the market is sitting in the start of recovery, and I'm going to show you that at the moment. So if you look here, these are all the parts which are growing. So all the cities which are in the start of recovery and a rising market, and that's natural. And the reason for that is because we've been through 12 months of one of the worst times from an economy point of view. So the market has declined, and I'm going to show you what happened about 5 months ago, and you can see how the market is starting. So the market is starting to rise. The market is in recovery mode, and it's rising across the country. Places like Adelaide, where you take Adelaide, you take Brisbane, you take Canberra, Melbourne, Sydney, all of them. Darwin is starting to rise again. Now the parts which are starting to decline, and this is sad that Wodonga is by itself over here, but you can see that the regional areas are starting to come off the boil now. Yes, there were the main markets which were going up in a lot during COVID time was the regional areas, but now the regional areas are starting to slow down a little because they're approaching the peak of the market. So that's the situation. Now these are for houses, and now you can see the market for units are similar in that respect. A lot of them, they follow similar, but there are differences, but there are also similarities, because the rising market at the moment for properties, we are in a very hot market, especially places like Brisbane, the Sunshine Coast, and the Gold Coast. The markets are very, very hot. In fact, even here in Melbourne and Sydney, to get title land is one of the hardest things which we are finding at the moment from a research perspective, to find land which is titled and ready to go. And I'll talk to you a little bit about that and why that is. So you can see the units. There's a declining market in Canberra. The market there's a lot of properties. I was in Canberra last week. There's a lot of properties on the market over there, and the market is declining, and it's come off its peak, and it's sitting in a declining market at the moment in Canberra. Okay, now this, as I said, this information is from Heron Todd White. Now it's going to be interesting, because what I'm going to do now, I'm going to compare this to 5 months ago in November 2020. This is what the property clock looked like. And if you look at it, the two major ones which were here was Melbourne and Sydney. You look at it, that was a declining market, and we all know that in 2020 the markets in Melbourne and Sydney started moving down a bit, and it was declining. And you can see that, but you can see that in this chart over here in November. So this is for housing, and you can see places like Sydney and Melbourne these are the two major ones which are there. But what has happened in 5 months' time, if I go back here, you look at it, the market has changed. It started from recovery, and it's in a rising market now. So you got Melbourne and Sydney over here. You got Melbourne and Sydney. So you can see in 5 months' time how much it has changed. And those are the two major markets of Australia. The same thing with units. Now I'm going to look at units. So I'm going to look at units in the similar thing. This was in November 2020, and you look at it. Units, we were in the declining market: Canberra, Perth, Melbourne, Sydney, Newcastle. Okay, all these markets were declining in November 2020 when these statistics came out. Places like Ipswich, Broome, Bundaberg, Albany, and all that, they were at the bottom of the table, bottom of the market, including Alice Springs. But then move forward. In 5 months' time, in April, and you look at where the market is going. The market, especially Sydney, Melbourne, Perth, the major cities, has started rising. Gold Coast, Sunshine Coast, all of them are in this sort of rising market, and it's just natural that that's what has happened. And the reason for that is because COVID has taken a hit on the markets, and now we're starting to see that rise. Okay. So that's where we are at the moment as far as the property clock. Now, what you look at the movement now, again, as I spoke about it, now here you can see the major cities. When you look at Adelaide, Brisbane, Gold Coast, Sydney, Melbourne, and Perth, I've looked at these six major cities, and you can see, let's take Brisbane, for example. Brisbane has been flat, pretty much a flat market for the last 8 to 10 years. But as you can see now, from last year, it's starting to rise, and the market is starting to increase over the period of time. So is it a good time to buy in Brisbane? The best time to buy in Brisbane, buy in any market, is between 6 o'clock and 9 o'clock is the best time to buy. So again, is it a good time to buy in Brisbane? Definitely yes. Gold Coast, you can see that happening. Last year, I know Kevin was predicting that the Gold Coast and the Sunshine Coast is similar markets, and he said that's the market. With last year, he told us this is a good time to buy in the Gold Coast, and you can see last year, it was 2020, it was just starting the recovery, and now 2021, it's sitting over there. The market is very hot in the whole of Southeast Queensland, so it's definitely something worth looking at if you're in the market, and if you're looking at properties over there. You can see that, and I can see that in my own personal portfolio with the properties. The rents started going up, and then the rents follow, the capital growth follows the rent. So, and I'll show you that a little more about how the finance is working. Again, Sydney, you can see Sydney was very flat for a number of years, and now it's starting to pick up. There was a downturn in Sydney in 2020, but now you can see it's starting to recover again. So again, that's what we need to look at, and that's why I think the major cities now in the next 12 months or the next 12 to 24 months, there's going to be good growth in that. And even Perth, you look at Perth for the last 4 or 5 years was on a downward swing, but now it's starting to recover, and I think Perth is also is in an upswing at the moment. So you can see there's a lot of movement around the property clock over the years, and this is how we get our numbers. And again, this is taken from Heron Todd White, where we've got the statistics from there. Okay, now the next slide. This is a very, very interesting slide, and again, I think we know that much of the housing market's current heat is being driven by cheap money, and interest rates are low. We're getting finances is easy, not so much as easy. It's becoming easy to get money because our borrowing capacity is getting higher. And then all the recent government incentives, with the first home buyers, they've had so many bonuses. Then we've had the federal grant getting 25,000, then it went to 15,000, and all this is helping owner occupiers and first home buyers. So that was the major push. But now also investors are joining the fray. At the moment in Melbourne, up to the 30th of June, you can get up to 50% of the stamp duty savings. If you buy a new property which is in the process of being built, or you get 25% of if you're buying a house and land package. So there's various incentives which are coming up. And again, so what has this created? It has created the new construction has been the big winner in this. And I'm going to explain to you about this particular screen. When you look at these charts, and you can see that house prices have started rising, and median prices have started lifting by about 10%. Okay, on an average across the country over the last 12 months. And last 12 months, as we know, COVID has affected every one of us, and now we're seeing the growth coming back. And we are in a lucky country because Australia's, I think, one of the least hit countries compared to when you look at what is happening across the world. It's quite scary what is happening. But what we don't know is whether this price growth will continue. So, and how much it's going to continue and how long it's going to go for. So this is something which Kevin is asked this many times. So I'm going to show you these two charts, which is from Michael Matusik, and many of you know who Matusik is. Again, this is from him, and again, this is available on if you subscribe to him, you can get this from him. And again, it talks about the annual change in housing finance, and you can see historically, when the housing finance goes up, the price of houses go up. When the housing finance goes down, the price of housing comes down. Okay, and we're talking about an average over here. So when you look at here, now what he has done is he's predicted this over the next 6 months. So you look at 2020 and it started to climb up, and now you look at 2021, it's starting to rise. And you look at housing finance has gone through the roof. It's just gone straight up. And this is what they are predicting over the next 12 months. And so therefore, if the housing finance is going up, and you can see it's starting to go head straight up, then what is going to happen to housing prices? It's going to start going up. Okay, that's just the way it works. And when you look at this next chart, and the next chart really brings it out into the actual situation where you'll see it. Okay, when you look at this with the chart one, we saw the relationship between housing finance and the housing prices. And here, what we look at, if we look at past relationship between the housing finance and the housing prices, okay, you can see the market was down, and December 2020 was here, and you can see the market was a bit low, and then the housing finance just kept going up. So housing finance went there to March 21. What happened to the price of housing? It went up. And then you look at June 21, it's still going up. And look at September 21, where it is. So in the next 6 months, they're predicting the market is going to keep rising, and the market is rising. This is the average prices. So the market is starting to climb. So what does this show us? That if you look at history and you look at where we've come from and where we are heading, housing finance is really important to show us that the housing finance is going up, and therefore the house prices should go up. Now, again, I don't have a crystal ball to tell you that it's going, but if you look at the data, it's showing us that that's where the market is going. Anyway, so that's my opinion, and that's let's have a look. Let's see how hopefully this is. And Kevin Young, who's the founder of the club, and many of you know who he is basically is saying the same thing, that the market is on an upswing, and it's a good time to get into the market. Right. So the next question I have is, what determines the position on the clock? And again, the Financial Review, we've taken this information from the Australian Financial Review, and you can see what determines it is clearance rates, the auction clearance rates which are there. And you can see last year the market was struggling to get 50%, 60% clearance rates. Now we're up to 80%, 90, 85% in clearance rates, and that is a good sign for the market going up. The gap in the pricing and the number of listings, that's an important part, because you see the number of listings. We used to have hardly any listings last year, but now this year the number of listings has started going up, and the way and how fast the property sells. You know, before it used to be 60 days, 30 days, and now it's down to 15 and 20 days. So, and then the type of buyer we're looking. Last year we were looking at a lot. We were trying to. The government was trying to encourage the first home buyers and owner occupiers to start buying, but now we're looking at there's a lot more investors coming into the market. And then, of course, the interest rates have been very low. And then the last one is employment. When you think about employment, last year all of us were in a similar situation where we're not sure what's going to happen with our jobs. Now things have settled down a little more. And again, when just you're talking to people are a little more confident that they've got their jobs and they're going to continue having their jobs, and therefore they're more confident in investing. So that's what we take into consideration. Then there's some other factors also which we look at. You know, we look at assessing the market. You look at the stagnant interest rates, because that's important also. And you look at inflation, and what will happen when the demand rises, the prices will increase. And when you think about it, yes, we're not having the international migration has kind of slowed down a lot, as we all know. But what is happening now, there's a lot of expats who are coming to the country, and a lot of expats have money, and they are buying properties, and they are pushing the market up, and that's an important part of where it is. A lot of the rentals and the buying, they're coming back with money, and they're able to afford to buy the properties, and that's what is pushing up the prices. And I think that's where we are heading. Again, auction rates, we have got now it's moving again. It was started off with lower clearance rates, and now our auction rates are much higher. And again, as we said, the market is the short time it's on the market, and very rarely will you see a property on the market for 2 months and 3 months and all that. And last year that was the case. You know, I had someone who was trying to sell a property, and it took them over 4 months to even sell the property. And there was nothing wrong with the property, but it's just that was the market and the time. And yeah, there's so many properties. If you read the papers and you read the Real Estate Institute guides, and you'll see that the market, the price of properties are going much higher than the list price. So yeah, so that's the situation. So so what I'm going to talk to you about now is how can the property clock assist you? So what we look at is, what you need to look at is how much equity you have in your property as an investor. If you're an investor, then it's definitely worth looking at the property clock and then talking to your broker and finding out how much equity you have, because the markets are changing all the time. So what you look at is refinance. You look at refinancing your property if you can, and then you take out the refinance and keep that. So, and then also you look at when to purchase. Again, now is a good time to purchase, and the market is showing us that. And the other option is, when you look at the market going up, then it's important to see how you can increase your rent, because that's another important thing to look at, because the more rent you get, the less interest you pay, the more money you're going to make on your properties. Okay. And then when to hold the property, because that's an important part about how long you want to hold the property for, and then how long you want to sell the property. So yeah, so let's see what is the summary. So the summary from all this thing, I hope I've given you guys something about to think about. But this is what, for me, the property cycle and the property clock is all about the good times and the bad times, and when is a bad time, when is a good time. So the time to add or to buy property and to add to your portfolio is when the clock is sitting between 6 and 9, and the banks allow you to borrow. So as long as you can afford to borrow, then borrow, and it's good time to buy when the market is sitting around 6 to 9 at the moment. When it's time to hold, you want to sit and hold when you're in a downswing. Okay, you want to sit down, and that's where you have to sit and wait. Time is important, and this is where you have to be patient. But when the clock, when your market, when the city or the place you buy, when your property is sitting between 12 and 6, is when you have to hold. And I know sometimes it's very frustrating to do that, but that's the time to hold the property. And then you have the time to take the equity when you're back. If you're investing and your market is starting to rise, it's a good time to take the equity between 9 and 12, because that's when you get your best. The property is going to be at its best, at its peak. It's nearing its peak, and that's the time to extract the equity and to look at buying another property, or you look at refinancing and store your equity which you can have. The time to sell is never a good time to sell, and it's only on a needs basis. If you really need to sell the property and the banks allow you to sell it, then that's the time you need to have. So that's important. So as far as a summary is concerned, I reckon this is a good thing about buying, holding, taking the equity, and then selling the property. So I hope I've given you a short introduction and a short summary about the property clock. And if you have any questions, please feel free to contact your property mentor, or the other option is you can send an email to enquiries@propertyclub.com.au, and then someone will get back to you. The email is enquiries@propertyclub.com.au, or please contact your property mentor for further information. I hope you have got some insight into the property clock, and I thank you for attending, and good night, and I hope all goes well, and happy investing. Thanks everyone. Bye for now.